So many people have got it wrong. They think that when interest rates rise, property prices come down. It couldn't be further from the truth. What? Like, how does that make sense, PK? Yeah, well, let me show you. Okay, if you're worried about interest rates rising and you think that property prices come down, you're simply misinformed. Okay, let me teach you through data what is most likely to happen based on history, and then you yourself can make your own mind up whether it's prudent to invest in property or buy a property now, or whether it's not. If you're interested, keep watching. My name's PK and I help people build passive income through property investing using data, using the Property Investment Accelerator mentorship program without needing to drop $15,000 on a buyer's agent every single time. This channel exists to help you with three things. One is property investing. Second is global and local economy. And the third is financial happiness. So if you're interested in any of those, hit the subscribe button and make sure that you give this video a thumbs up, because it will completely change your worldview about the economy and its relationship with house prices. Let's go. So first of all, I have to credit John Lindemann for this chart. It's his and great insights, and I'm basically going to be expanding upon what he's saying as well. So let me explain this to you, okay? Really, I want you to understand this and digest this. This black line is Australian median house price in the last 30 years. So basically, it's gone up all the time, okay? Then this yellow line is the standard variable home loan rate, okay, in the last 13 years. So you can see back in 1990, it was well above 13%. And you can see that it's consistently gone down. Okay, so at just a high level, ignore all the reds. Someone could make the assumption or inference that, house prices have gone up because interest rates have come down. And look, by and large, it's hard to say that that's not true. But, what John's arguing is the opposite true or not? When interest rates go up, because there are instances where they have gone up, what have house prices done? Okay, and then let's just kind of deep dive on 5 examples here. So the first time was in the early 90s, interest rates went up by 1%, okay? And so they went from about 9% to about 10%. Okay, what did house prices do? They didn't really go down, did they? Let's fast forward to just after the dot-com bust in year 2000, interest rates went up 1.2%. And that's that's a pretty big increase in monetary policy terms. What did house prices do in that same period? They went up. In fact, they started going up faster. That gradient was faster than this gradient. Okay, fast forward to the global financial crisis, or thereabouts, or just leading up to it. Interest rates, the economy was booming. Resources sector was just on fire in a good way. What did interest rates do? They increased twice, okay? 1% here and then 0.25% here, okay? You can see that this yellow line actually increased, okay? Quite significantly. And so what did house prices do? They further increased, okay? And then the last one was in this kind of 2011 period when, once again, we were out of the global financial crisis and things were looking good. The Reserve Bank thought, well, things are overheating a bit, in terms of the economy. Everything's hunky-dory. Let's slow this down so it's more sustainable. Interest rates went up once again. And when I say interest rates, I mean the standard variable home loan rate. Real interest rates, okay, what actually matter. And you can see that this yellow line went up quite sharply, and, well, since that time, in property prices, this black line continued to go up. You can see here it flatlined, but interest rates started going up here. And in that time, they definitely went up. The black line, property prices definitely went up. So I'm going to leave this chart here for a second while I explain something else so you just can digest it and absorb it for your own self. This is obviously the interest rates, and this is average median property prices across Australia nationally. Of course, there are markets within markets. There are some times where sub-markets would have been the opposite of this black line, and sometimes it would have been sub-markets that it would have been even more pronounced or even greater increases. There's always markets within markets, but you're thinking this doesn't make any sense, PK. Like interest rates would be going up. It's more costly to borrow money from banks. Why on earth would property prices continue to go up? There's two reasons fundamentally. The first reason is that there's more to supply and demand than just interest rates. Okay, obviously interest rates are important, right? But there's more to supply and demand than just interest rates. Interest rates are only one component of demand. Okay, and the second more fundamental reason I want to elaborate upon is that there are three types of property owners in Australia, and they all own about 30% of property. Okay, so think about if all the properties in Australia, 30% of properties are actually owned outright. 30%, or one third, okay? There's actually no debt on these. So for these people, older generation, closer coming on to retirement, these guys have no debt, right? If interest rates go to the moon, it doesn't matter for them. They have no debt, okay? That's 30% of Australia, incredibly strong property market. The second 30%, or the second third of property owners in Australia are property investors. Okay, property investors. And property investors are less impacted by interest rate rises because of two reasons. The first is rents. Okay, your interest rates go up, your cost of borrowing, cost of holding a property goes up, but it can be offset by rent increases. Okay, so property investors just say, all right, well, I'm just going to increase the rent. Okay, especially in this current environment where we have a huge rental crisis. You guys will know this. It's hard to find a rental property if you're a tenant. Rents are just going to rise. I think personally, I've done another video on this, probably the steepest, sharpest rise in rent per week in probably the last 30 years. Okay, so that offsets, or sometimes more than offsets, the property investors' cost of borrowing. And the second reason is tax outcomes. Even if it doesn't offset it, if they're having to pay another $100 extra in interest payments than they were before because of interest rate rises, a third of it, or almost 50% of it, they can claim on tax. So it's not actually a huge penalty for them. Okay, so for the first category, the first third of property owners, they have no debt. The second, investors, this is a generalization, but a lot of them are, simply less sensitive to interest rate movements, or not sensitive at all. And the third category of property owners are those who are more like first home owners. Okay, so these guys are the most sensitive to interest rate movements. But even within this category, and I should say not just first home owners, but second home owners or third home owners, but they have a debt. So they're not like the first category, which are debtless. They actually have a debt. But even within the people who are living in their property, they have a debt. The vast majority must have bought their properties, or would have bought their properties 5 years ago, 10 years ago, 15 years ago. So they've been paying their debt down, their mortgage down. So, interest rate goes up by 1%, but they've already paid most of their debt off. It doesn't really matter for them, right? And it's not like they're going to sell their family home just because interest rates go up. That's the last thing they want to do. The ones who are really affected by interest rates movements are like a sliver of this last third of the pie chart, this last third category. It's the people who, yes, they have debt, but they're first home buyers. They just bought in the last year, or they just bought in the last 2 years, so they haven't had the opportunity to pay their mortgage down. They have a large mortgage, and if they've bought, really stretched themselves to buy in Western Sydney or Western Melbourne, or in the Brisbane context, Springfield, Ipswich, really far north, and Mango Hill or North Lakes, or down past Logan around Beenleigh. It's these people that are most affected by interest rate movements, okay? So I just want you to understand that the first third of property owners, not affected at all. They don't have debt. The second third of property owners, investors, they're not really sensitive that much to interest rate movements because of negative gearing and the fact that rents rise far quicker than interest rates rise. The third category, only a sliver of that category are first home owners, okay? So they have debt, but they haven't had a chance to pay it down that much. So that's why you see these kinds of trends where even though interest rates go up, the property prices continue to go up. And so your logical next question becomes, okay, well, PK, property prices have definitely gone up when interest rates have gone up 1%, 1.25%, 1%, 0.25%, 0.75%. What if interest rates go up way more than this? Okay, so what if, we have an unprecedented environment where interest rates go up hugely? Well, let's look at this. In the last 30 years, what we've seen is that inflation rates have gone up and down. That's the red line. Okay, we've got up and down, and then therefore interest rates or monetary policy has been maneuvered or manipulated to make sure inflation rates come back down. And so you can see in the last 30 years, interest rates have not ever gone up more than 1.25% at any one go. At any one go, they've never gone up 1.25%. Even when inflation was up at 4%, see inflation here? 4%, 4%, 4%. Interest rates never gone up more than 1.25%. Okay, so right now, underlying inflation rate in Australia, CPI, is running between 3 and 4. Even if you said it got to 4, even if you said it got to 5, which is unlikely to happen, but let's just say it got to 5, interest rates are unlikely to go up more than 1 or 1.5%. In fact, the market is predicting between 1 and 1.5% over the next 2-3 years. It's a smooth process, not a sudden jolt. Okay, so the reason I wanted to illustrate this is that the data that you saw here is actually reliable. It's unlikely or near impossible that interest rates are suddenly going to go up. Some people are saying worst case scenario is 7%. That's not quite how it works, all right? So hopefully that, kind of disentangled all the fear-mongering that Channel 7, Channel 9, AFR, News.com, Current Affairs, 60 Minutes, 7:30, ABC, all this fear-mongering that the media puts on you and prevents you from getting ahead. Now, you may think, look, I'm biased, I'm a property person, but you can interpret the data the way that you want. My name's PK, and I sincerely hope that this was educational. If it was, hit the subscribe button, give it a like, and just remember that you can really achieve financial happiness through education. Knowledge is power. You can't outsource this stuff, guys. You need to understand it. It's that important. I'll leave links below if you really do want to understand it. Okay, so the Facebook group, more than 13,000 people, join, get involved, learn from so many successful investors. The podcast, Level Up Your Knowledge, it's free. And then obviously I'll leave a link to the Property Investment Accelerator Mentorship Program as well. Thank you guys. Thanks for being with me. I really appreciate you, my community, and I hope to bring you more and more value in the next few videos. Catch you later. Bye.